Swayam Prabha. Digital India. Educated India.
Good afternoon, dear students. Today, in this particular lecture, in this particular video, we will be discussing the concept of risk, various types of risk, various categories of business risk, assessment and transfer of risk, and at the end we will also be discussing about insurance, its features and its basic information. So let us start. So, dear students, first of all, you should note that risk is everywhere, and you know that whenever you are traveling and whenever you are doing something, whenever you are producing something, in case of a business, in case of each and everything, risk is there. Risk is there, and when there is a risk, in case there is a risk, there will be insurance. In case no risk is there, and uh, in case a large chunk of population, a number of companies are not subject to risk, some specific kind of risk. So, in order to cover that specific kind of risk, insurance companies would be there. So, in case no risk is there or very unique risk is there, various companies, you may say, various persons are not subject to it, then even insurance companies will not be able to earn something. So insurance companies will not be moving to such kind of area. So what is risk? It is the possibility of loss or damage due to factors over which we have either no control or we have control, but that is too little, very less control is there. So in order to deal with such things, what is needed? Some sort of insurance is needed, and insurance cover will be given. You will be able to transfer your risk to the insurance company only in case a major chunk of population, number of companies, number of industrial houses are subject to such kind of risk. Only in that case, companies will be interested in accepting such risk. So it should be kept in mind, my dear students. Now, moving next, what are the various types of risk? Kindly note, number of risks are there. I have just told you various types of risk. It is risk is there in traveling. As far as various types of risk are concerned, please note that it may be pure risk, it may be speculative risk, it may be market risk, it may be credit risk, it may be operational risk, it may be strategic risk, it may even be liquidity risk, financial risk may be there, non-financial risk may be there, or it may be particular risk, fundamental risk, static risk, and dynamic risk. In addition to these, also a number of categories might be there. Business risk I will also be discussing after discussing these risks. So now let us start with pure risk. Now, dear students, what is pure risk? Kindly note, in case of pure risk, in case of pure risk, what would be the outcome? In such cases, the outcome will be either a loss or no loss. That is the status quo. That is the break even as it was earlier. So chances of loss are there. In case something will happen, it will result in loss, or in case that happening is not there, in that case no loss will be there. Status quo, as which is the current status, that will be there. So but the main thing is that in pure risk, it can never result in some benefit, it can never result in some profit to the person. Let us assume some fire is there. Let us assume some fire is there in the factory. So in case some fire is there in the factory, what would be the outcome? It may destroy the building, it may even destroy the stock, or some other destruction may be there, or some other destruction may be there, but it will in no way be we will be benefiting the company. So that is the pure risk, in which either it will be resulting in loss or no loss, or but no profit, but no chances of any benefit would be there. And majority of you may say population, number of companies are affected by this. That is why pure risk is insurable, fully insurable. And I think you are aware regarding fire insurance and various other categories of insurance. Now, speculative risk. Again, my dear students, kindly keep in mind, in case of speculative risk, what will be there? Here, the direction of the outcome is not specific. Three directions may be there. It may be resulting in a loss, it may be resulting in some benefit, some profit, or the third category may be the status quo, that is the break even, no profit, no loss. But the again, one thing that should be kept in mind is that speculative risk is not insurable. There is no insurance cover available for speculative risk. The reason is, and the example may be when you are buying shares. When you are buying shares, then three possibilities may be there. Either the price of the share you have purchased may fall, or the price of the share you have purchased it may rise, it resulting in some profit to you, or it may remain at the same level. It may also remain at the same level. You see, very recently, due to Russia Ukraine war, you might have seen that the market had crashed, and it has resulted in huge losses to various investors. So, speculative, in case of speculative risk, all the possibilities may be there. Now, market risk. Dear students, what is market risk? As I have already told you that risk is everywhere, uncertainty is everywhere. So when the exposure to uncertainty is due to is as a result of changes in the rate or market price of the invested asset. So in that case, it may be due to interest rate, equity values. In that case, it is known as market risk. It will be dependent upon the market forces and our the value of our investment, the value of our market price of the asset. Now, what is credit risk? Again, I have already told you, credit risk is basically concerned with that given some, you may say you have sold some goods to some party, and it is very common in business, but uncertainty is there. That party may become bankrupt, and that party may not be able to meet the financial obligation under the contract. So it will be resulting in a loss to you. Now, operational risk. Simply, you may say that the risk of loss from everything other than credit, market, and interest rate risk, it is covered under operational risk. So, in case business is there, number of formalities are there, staff issue may be there, raw material issue may be there, machine issue may be there, human resource issue may be there. So in case, in order to operate the business, various types of risks are there, and basically these are operational risk. It may even be related to product, process, and all that. Now, what is strategic risk? I think you know what is a strategy. It is a long-term policy. The it will be dependent upon the company's future is basically dependent upon the strategies being made by the company. So, strategic risk basically arises due to exposure to the uncertainty that is arising out of the long-term policy decisions of the company. So, that is there. Now, financial risk and non-financial risk. In case, it is very simple. In case the outcome of the event is measurable, we are able to ascertain the outcome of the event in terms of money. So then, in that case, it will be known as financial risk, and the insurance is available as far as financial risks are concerned. Insurance companies are ready to cover such kind of risk. As we are able to know, we are able to measure that what is the quantum of loss, what is the amount, what is the you may say amount of particular loss. As I have given you the example of fire in the factory, so that we can measure, that can be ascertained, and that is measurable, that is why it is insurable. Now, what is non-financial risk? In case the outcome of the event is not ascertainable, it is not measurable, we are unable to measure it in terms of money, we are unable to find out the monetary value of the loss. In that case, it will be known as non-financial risk. And again, I would like to say that these types of risks are not insurable. Insurance companies will not be accepting such kinds of risk. Insurance companies will not be accepting such kind of risk. So it should be kept in mind. Now, particular risk. You see, the impact is very less, the impact is very low, and these are basically at a localized level, and such a particular risk will be affecting a brief limited area. It may result from the negligence, it may result from error in judgment, it may even result from carelessness, and it may also result from disregard for law and all that. So it will be affecting a particular entity, a particular area, a particular, you may say, a particular person. So a particular risk is also insurable, and the insurance companies are covering such type of risk. Now, fundamental risk. Now, what is there in fundamental risk? What is unique in fundamental risk? That this risk basically is there due to the factors, due to the causes which are not under the control of any person, and it impacts large population. So various things may arise, but fundamental risk, the unique point is that these risks are easily insurable. Like some economic slowdown is there, some natural calamity may be there, so it will be affecting the major area, but still these are insurable. Now, static risk. What is static risk? It will be static, it will be fixed, it will remain constant over a long period of time, and it is generally not affected by the business environment, by the prevailing business environment. And the unique feature of static risk is that it is fully insurable. And now, dynamic risk. In case some changes are there in the economy, let us suppose some changes are there in the taste and preferences of the customers. In that case, it will be dynamic risk. It will be known as dynamic risk. And the unique point is that it is very difficult to measure, it is very difficult to, sorry, predict. It is very difficult to predict the dynamic risk. And as far as insurance cover is there, insurance cover is there, insurance companies will not be covering such kind of risk. So dynamic risk is not insurable. Now, dear students, moving ahead, what are the types of business risks? So, I would like to say that various types of risk may be there in the business. It is very easy to say that businessmen are earning crores of rupees, businessmen are earning billions and millions and billions. But what is the harsh reality? That it is very difficult to manage a business. We are always appreciating the successful entrepreneurs, but various entrepreneurs have, you may say, have destroyed their business. Their business has been destroyed due to various risks. So let us discuss these type of risk. First is economic risk. That may be due to economic environment, various things, various changes that are taking place in the economy, various places that are taking place in, you may say, banking sector at a government level. So business are subject to these risks, and it may even, the business may even, the company may even go out of the business due to economic risk. Then legal risk is there, compliance risk is there. In a country like India, number of statutes, number of laws, number of legal enactments are there, and we are bound to obey, we are bound to abide by all of these legislations. So in case some, it should not be there, I am not saying so, but in case we are unable to abide by some provision of some act, so it may harm our company, and we may have to pay a very heavy compensation, very heavy penalty may be levied. Then operational risk. This I have already covered while discussing the type of simple risk. So it may be due to some HR issue, it may be due to some raw material issue, it may be due to some machinery issue. So it is basically operational, relating to operational aspect of the business. It may be due to product, it may be due to process. So that is basically operational risk. It has nothing to do with the interest rate and inflation and all that. Now, financial risk. The risk that can be measured, the outcome of which that can be measured in monetary terms. That is known as financial risk, and it is fully insurable. Then, in addition to that, my dear students, kindly note technological risk is there, competition risk is there. Technological risk, what is technological risk? The technology is changing, it is changing day by day. I think you are aware that every day new mobile phone is there. Every day we get the news that some new mobile phone with unique features has been introduced by some company. And similarly, at the business level, various machines may be there. And once you have purchased a machine after spending crores of rupees, that may even get outdated after a few years or after a few months. So, and in order to remain in the business, you would have to buy the new technology. So the depletion, you may say the obsolescence may be there, and it will be very risky for the business. Similarly, competition risk is there. You are doing the business, and some competitor, some big competitor, some MNC, large company may come, and that may enter the in the field of activity in which your company is there. So you may be out of the business. Either you may go for some merger or acquisition, otherwise they may throw your company out of the business. So it is very risky. The company may be out of the business sooner or later. So it may also be there. Similarly, what happens that sometimes we choose the comfort zone. We are aware that we should make sincere efforts in order to grow, in order to tackle, and future is not so cool. In future, various new developments are there, and we should change ourselves. We should change our product in order to remain in the business. But sometimes we are, due to our lethargic attitude, we are unable to change ourselves, and we stick to the comfort zone. It may also be very risky for the companies. But here it is necessary to know that which kind of risk, which type of risk may be transferred, and which type of risk may not be transferred. That we will be discussing in the coming slides. Now, dear students, after discussing various categories of risks, after discussing various types of business risk, now comes the next point, that is risk assessment. Now, first of all, what is risk assessment? You see, various things are there, various situations are there, various processes may be there. Due to that, some harm may be there, which may be harmful, and which may be affecting adversely our, you may say, product, our people, our building. So that is there. So it is required to make a proper risk assessment. And what is there in case of a risk assessment? Here the identification is made. We are basically concerned with identifying those things, those situations and processes. They may prove to be harmful to, I have already told you, to building, to people, and all that. So what is there? What is there? We will be, first of all, we will be identifying the hazards. We will be identifying the risk factors, and that we will be identifying the risk factors that may be harmful. So it is known as hazard identification. Then risk analysis is there, and risk evaluation is there. Here we will be analyzing in detail. We will be evaluating the risk in detail, the risk that is concerned with that type of hazard, which we have already identified in the stage second. Then what is there? Then you are aware that some hazard is there, and now you are clear. You have evaluated that some risk is there. Now what to do? Now what to do? Whether we are able to eliminate the hazard, or whether we are able to control the risk in case the hazard can't be eliminated, then what to do? What should be the next step? Now, once again, in brief, I am telling, I have already covered what are the elements of risk assessment. First of all, hazard identification. You will be finding, you will try to find, you will try to make a list, and you will be characterizing these hazards which are there. So first of all, these are required to be identified, and it is very crucial step in case you are unable to identify some hazard that is actually there. So it will be proving very it will be very harmful to your company, and it will really be destroying your company. Then risk analysis. Here the hazard will be comprehended, it will be analyzed in detail, and it will be analyzed that what is the level of risk, whether it is too high or moderate or it is negligible. In on that basis we will be evaluating the risk, and then we will be deciding that how to control this risk. And as far as risk estimation is concerned, that is also covered here. Then risk evaluation. We will be evaluating the risk. We will be keeping in mind various things while evaluating the risk. Then we will make decisions. We will comprehend, we will see what type of actions may be there for controlling this risk. So that type of actions will be decided. Now, what is the significance of risk assessment? My dear students, kindly keep in mind that in case we are doing some risk assessment, so we will be able to know, at least we will be able to get an idea, at least we will become aware that some risk is there, that some hazard is there. It is applicable in your personal life also. In case we are assessing the risk, I don't say that we will always be in a position to control the risk, but at least we have an idea. We may manage it in case we are aware that some hazard is there, some risk is there. So first of all, awareness of risk is very necessary. Then we will be able to know. Then in second case, we will be able to identify the workers, the employees, the particular department, the particular area where where you may say risk will be more. We will be able to identify the vulnerable employees, workers, and area. So why I am concentrating on this thing, that we are in a position to, in case we have identified the risk, in case we have identified the vulnerable group of employees, in that case we may take special precautions in that area in order to avoid the risk, in order to avoid some chances of any chance of some mishappening. And accordingly, keeping these things in mind, we may devise an effective control measure. So we will be devising some control measures, keeping in mind the level of risk, keeping in mind the level of hazard, and we will be in a position to, you may say, appreciate. We will be in a position to know where you may say high degree of control is needed, and where we may go with some normal control. And it should also be kept in mind that once we have taken such steps, it will not eliminate accidents are bound to happen, and you may say even after various road safety measures and all that, still we see that accidents are there. But accidents are there, accidents can't be eliminated, but at least we are able to prevent, we are able to reduce the occurrences of accidents and some other mishappenings. Now, risk control. My dear students, we know that risk is there. We know and we appreciate, we know, we understand that risk is there. Now, how to control the risk? You see, it may be four categories may be there in order to control the risk. Risk avoidance may be there, risk reduction may be there, risk retention may be there, and risk transfer may also be there. Now I will be discussing all of these one by one. What is risk avoidance? It is also one of the strategy to manage risk. It is the main strategy to manage the risk. That is, you should eliminate any exposure to the risk that may pose a potential threat, that may pose a potential loss. That is avoiding the risk. In simple language, I am telling, let us suppose risk, you know that risk is there. Whenever you are going on the road, risk will be there. So one thing may be that you should avoid going to that particular road. So it will be covered under risk avoidance. But it is not always possible. We know that it is there. Sometimes we know that some exposure to risk is there at a particular point, at a particular place. And in case it is feasible, in case it is possible, we may avoid going there. Similarly, in companies, we may think of some example and we may adopt this strategy to manage risk, that is risk avoidance. Now, risk reduction. Now, risk reduction. In case we see that risk is there and it can't be eliminated, then the another strategy to manage risk is risk reduction. That is taking steps to reduce, taking steps, creating mechanism to reduce the likelihood of the possible loss and the severity of the possible outcome, that is possible loss. So by making such efforts, by doing such things, you may do so, and it is also a strategy to manage risk. Then risk retention. Now, what is risk retention? That is that we are retaining the risk. We are not transferring it to anybody. We are taking the full responsibility for a particular risk. Now, my dear students, when this may be there, when this tendency may be there, you see, being students of finance, being students of economics, you know that in case you find that the cost of retaining the risk is less than the cost of fully or partially insuring against it. In simple words, when you are taking some policy and the premium is much more, and you feel that the cost of retaining the risk is very less as compared to the cost of policy, cost of insuring this particular risk. In that case, what would you do? In that case, you may try to keep it. You may try to take you may even take full responsibility of this particular risk rather than going for insurance. And in case, let us suppose, I have already told you that insurance cover will be available when a major chunk of population, when a number of companies are affected by a particular type of risk. Now, let us suppose risk is unique and it is not insurable. No insurance companies, you may say, agreed. No insurance company wants to cover it. No insurance company wants to issue the insurance cover for this particular risk. In that case, it will be forced retention. Now, what is forced retention? When you will have to keep the risk, when you will have to retain the risk, and as no company is there, no company is agreeing to issue you the policy, insurance policy regarding that risk. Then risk transfer. Now, my dear students, comes the main point. In case risk is such as it is affecting number of companies, major chunk of population that is affected by this kind of risk, and in that case, what would be there? It may you may shift the risk, you may shift the pure risk to the insurance company. What will be there? What you will have to do? You will have to simply buy an insurance policy. So risk transfer is an you may say risk management and control strategy where you would be transferring the risk through the insurance policy. So I would be discussing it in detail. Now the main thing comes, that is what is insurance. What is insurance? As I have already told you that risk transfer is basically transferring the risk by the you may say insured to the insurer. Here insured is, let us suppose ABC company is there. So ABC company wants to shift its loss, so its risk. So ABC company will be the insured, and let us suppose XYZ insurance company is there, and XYZ company is ready to issue the insurance policy to you. They have agreed to issue you a insurance policy to cover your risk. In that case, XYZ insurance company will be known as insurer. I have already told you, and some contract will be there. The contract will be between these two parties, as I have taken the example. And here the XYZ insurance company, as we have assumed in the example, they will, in exchange of a fixed amount of money, they will agree to compensate the insured. In our example, we had said ABC company, against the risk of loss or damage caused by the happening of certain events. So that will be there. The insured will be transferring some specified risk to the insurance company. So policyholder will be, you may say, transferring, policyholder will be passing some specified risk of loss to the insurance companies. And in return, I will also be discussing it in the chapter risk return relationship later on. The insurance companies will be charging a fees that is known as the insurance premium for accepting this risk. Now, what are the basic terms? Once again, I will be describing in brief. Insurance policy, the document that contains the contract between the two parties, that is the policyholder and the insurance company. Now, insured, the person, the company whose risk is insured. In case ABC company is there, they have taken a policy for their, you may say, for fire insurance, you may say. In that case, the that company will be known as the insured. In case a person has taken life insurance policy on his own life, in that case he will be the insured. Now, as far as insurer is concerned, the insurance company which issues the insurance policies, which insures, that will be known as insurer. Now, what is premium? You see, the company will be accepting the risk. You can transfer the risk to the company only for some consideration, and the consideration in return for which the insurance company has agreed to compensate the insured in the case of loss. So that amount, that consideration, that monetary payment is basically known as premium, and it will depend upon the magnitude of risk. In case high risk is there, in case the probability of occurring the risk is very high, in that case a higher premium will be charged by the insurance company from the insured. Now, nature of insurance, I will be discussing it in brief. First of all, I have already told you on various occasions that basically insurance is the contract of, you may say, passing of the risk by the policyholder, by the insured, to the insurance company. And companies will be accepting only that category of risk where a major chunk of population, where a number of companies are affected by this kind of risk. In case of unique risk, they will not be taking the responsibility, and you will have to retain that risk. So basically, insurance is a contract for sharing the risk. Number of persons are taking the policies, but probability of happening loss is very less. And in case of loss, the insurance company will be compensating that particular fellow, that particular company. So it is a cooperative device. Large number of insured persons is there, I have already told you, and it is not for earning profit. My dear students, kindly note, insurance saves you from risk. It is not, it can't be used as a mechanism to earn profit, and the payment will be made to you on happening of specified event. And in case that event is covered by, that risk is covered by your policy, only in that case you will be getting the policy. Principle of causa proxima is there. I will be discussing with you in the next video that what is the principle of causa proxima. And you will be protected against the risk, and you will be protected only against the risk that are stipulated, that have been given in the policy, and you will not be covered for any other risk for which you are not paying any premium. So it should also be kept in mind. And kindly note that insurance is not a charity, it is not a gambling. Rather, it is a cooperative device, it is a social device whereby everybody will gain, company will gain, and even person will gain. So you should not try the device of insurance to earn something. It is basically a strategy, it is basically a mechanism to, you may say, tackle the loss. In case some loss is there, so insurance will be compensating you. So that is there, and various principles are there. We will be discussing in the next video what are the various principles of insurance, so I will not be touching these in detail, but you should know that number of principles are there. And in India, IRDA is there. So it is not so that no regulators is there. IRDA is there, like RBI is there, Reserve Bank of India is there in order to control banking sector. SEBI is there in order to control stock market, mutual funds, and all that. Similarly, IRDA, Insurance Regulatory and Development Authority, is there to control the business of insurance in India, be it life insurance, fire insurance, health insurance, every category, be it government company or private company, all are basically regulated by the IRDA. And insurance is for pure risk. I have clarified it a number of times. Now, what is the importance of insurance? You see, it provides protection. You may concentrate on your own business, you may concentrate on business without worrying from any loss. In case it is there, in case some fire is there, and you have taken the policy, in that case, insurance company will be paying you the money. But once again, my dear students, I am mentioning it again and again that it should not be misused. You should not be using insurance in order to earn something. It is not so. Basically, the main theme of insurance is to share risk. It is a cooperative device. It is a cooperative device to share the risk. And number of persons are working as insurance agents. Number of companies are there, and now number of foreign companies have also, you may say, come to India as a result of liberalization, privatization, and globalization. And as a result, number of persons are employed in insurance industry. It may be life insurance or non-life insurance, and ultimately it is contributing a lot for the economic development of the country, and it is providing employment to a major chunk of population. And in addition to that, various types of insurance is there. Health insurance is there, and various other categories are also there. And basically insurance is providing social security to the population. And now, what are the major elements of insurable risk? My dear students, kindly note that every type of risk is not insurable. I have already told you that in order to be an insurable risk, some features should be there, some elements are there. Now, what are these elements? I will be discussing in brief. First of all, large number of homogeneous exposures should be there. As I have already told you, major chunk of population, a number of companies are exposed to such kind of risk, and it should not be some unique type of risk. Otherwise, no company will be issuing you an insurance policy for that, for covering that risk. And it should be ascertainable, it should be measurable, and loss should be accidental. It should not be pre-planned, it should be accidental. It should occur, it should be accidental, and principal amount should be justifiable. As I have already told you that in case risk is very high and probability of happening is very high, in that case the amount of insurance premium will also be very high. So, okay, dear students, it was all from my side. As far as risk is concerned, type of risk are there, and the types of business risks are there, and then risk assessment, risk transfer, risk retention is there. And at the end, I have also discussed something regarding insurance. I have tried to discuss its features and its importance. Okay, then, thank you. Thank you very much.